So I want to talk about something that I hear all the time, and that is, Matt, I heard that life insurance was way too expensive. Heard that life insurance was way too expensive. And so let's chat about it, because that may or may not be true. I guess it depends on your goals, and it depends on how you're measuring this. So the first thing, when we talk about life insurance being too expensive, you have to understand that life insurance policies are all going to be front-loaded with fees. That is a true statement. They're all front-loaded with fees, which means this is a terrible vehicle if you have a short-term time horizon. If you have investment goals that are, 2 to 6 years down the road, this is the wrong vehicle for you. If you're looking for the largest sum of money, you want to put some money away, you want it to grow, you want it to grow as fast as possible, and you want the largest sum of money in some short to medium term time frame, 2 to 6 years, this is the wrong vehicle. And I am upfront about that, because it's not going to do what you want it to do. It's front loaded with fees. In fact, it's like an upside down triangle. So you're going to pay the majority of the fees in those early years. And then as you go on, your fees get lower, lower, and lower. As the asset grows, you pay less and less fees, which is different than the way most people think of fees associated with their investment accounts. Because the way that most investment accounts work will be, you'll pay a percentage of the asset fee as a fee every single year. And as your asset grows, you pay more and more fees. So we got just a quick snapshot. This is not meant to be super technical or exhaustive. It's just, you're paying $30,000 a year, $36,000 a year, $3,000 a month into some asset. Let's say it's the stock market. Let's say it's growing at 10% a year, which is about what you're going to need in order to match an IUL's income, net of fees, net of taxes, which is why we're using 10%. And let's just say you're paying a 1.5% fee. Some of you are paying more, some of you are paying less. That doesn't matter. This is just illustrating the point here. At a 1.5% asset-based fee over 30 years, your total fees would have been just under $1 million, $900,000 in total fees over that 30-year time frame. And that's how most fees associated with investments work. The more money you have, the more you pay in fees, because it's a percentage of the total asset. We know that life insurance is different. We just talked about that. It's an upside down triangle. And so when we look at, so what we got here is just a snapshot of a life insurance policy value. And I know it's small, so I'll just call it out to you. In 5 years in the investment, let's get the laser pointer out. In 5 years, your managed account would have been $10,000 in total fees. The life insurance policy is at $32,000. And so if you say, man, I heard that life insurance was expensive. And I'd say, well, if you're talking about like the first 5 to 10 years, I'd say, yeah, it is, because you're paying all the fees in those early years. It's front loaded with fees because you have a death benefit, right? We talked about the death benefit being self-completing. Well, you can't have a death benefit without paying fees in the early years. We go to year 10, the managed account, you're paid $44,000 in total fees. The life insurance policy in year 10, $63,000. Okay, so the gap is narrowing a little bit. Year 15, the managed account's at $118,000 in fees. Year 15, the life insurance policy is at $91,000. Okay, so by 15 years, we've paid $91,000 in total fees in the life insurance policy, $118,000 in total fees in the managed account. By year 30, you've paid $896,000 in total fees. In the life insurance policy, you've paid $182,000 in total fees. And let me just kind of show you here where that is at the bottom. $182,000 in total fees in the life insurance policy over 30 years, $900,000 in fees in the managed account. Now, this isn't a perfect comparison because we're assuming a 10% rate of return on the managed account. The life insurance policy is not getting a 10% rate of return. There's a little bit less cash in the life insurance policy than in the managed account. But all told, you need about a 10% rate of return to match the income that you're going to receive from the IUL, especially if that managed account is like a non-qualified brokerage where you're paying taxes every year on the gains, or even if it's in an IRA where your income is taxed on the way out as ordinary income. And so for the conversation around fees, I think it's a pretty fair comparison because even if we had taken the growth down to 7 or 8% or dropped the fee down, you're still, the life insurance policy, if you're measuring it on a 20, 30-year time frame, it's not more expensive than a brokerage account. In fact, in a lot of ways, once you get past those first 10 years, it's much cheaper than a brokerage account. The average fees, once you get past those first 10 years in a life insurance policy, somewhere between 15 to 35 basis points a year, which is going to be pretty similar to like a almost no fee ETF that you could find out there if it's any good. And so, is life insurance expensive? Well, it absolutely is if you're talking about inside the first 5 years, because you're paying for a death benefit. Is it expensive when you compare it to what else is out there and you look at a 20, 25, 30-year timeline? I would say no, it's not. And so get that question all the time, and I wanted to clear it up for you.